Hey guys, Mike Frontera here, back with another edition of Retirement Theory. So, today I'm going to give a big slap in the face to conventional wisdom, and by doing so, hopefully convince you of why having a financial planner help you with your specific situation is so critical. You know, rather than just relying on some guy from the internet. Well, as you may have heard, it can really help to delay your Social Security benefits as long as possible. I mean, heck, I've given that same advice before on my own blog. You've probably also heard that you should spend your IRA money last in order to defer your taxes as long as possible. Well, here's one major reason why that could be just the completely wrong advice. Taxes. Aha! Our ugly friend rears its head again, screwing up our good intentions. Well, what I'm talking about is what can happen to your taxes when you delay Social Security, delay IRA withdrawals, delay, and finally you can delay no more. Age 70 and a half for the IRAs. So what happens? Well, of course, everyone's situation is different, but let me show you an example of how you can delay yourself right over a tax cliff. And then I'll show you how not to do that. All right, so in this example, we have Ron Revenue, or so he's nicknamed at the IRS. He lives in New York because he really likes paying his taxes, and he's single. And for the sake of this example, we're using 2019 tax rates only. In real life, those rates are subject to change, of course. So when Ron is 67 and a half years old, he has the following. He has a bank account with $200,000 in it that pays no interest, just to keep the tax picture very simple. An IRA account with $1.6 million that grows by a hypothetical 5% per year, and a yet to be claimed Social Security benefit of $2,000 a month. Now, Ron needs to live on $40,000 per year. So, going with the aforementioned conventional wisdom, he doesn't touch his IRA nor his Social Security benefits, electing for them to hopefully grow instead. So instead, he lives off the $40,000 of withdrawals from his bank account. He files as single and pays nothing in income taxes. Yet, fast forward 3 years to when Ron is 70 and a half years old. He still wants $40,000 of income. But now he has a bank account with $80,000 in it, still pays no interest, as he's drawn, the $40,000 a year for the last 3 years. He has an IRA account that's now worth $1,852,200 and a Social Security benefit claimed at age 70 of $2640 a month. Now, assuming his IRA account value was as above on 12/31/2021 and he turned 70 and a half on January 1st, his required withdrawal would be just under $70,000. His total income with Social Security would be just over $100,000. And now we have some problems. Well, first and foremost is that he's forced to take way more income than he needs to live on. Second, due to his income, his Social Security benefits are now 85% federally taxable. And again, due to his income, his Medicare premiums go up. He'll pay a higher premium on both Part B and Part D. He's not too far over Medicare's limit of income to pay standard premiums, but even $1 over and you're stuck with the higher bill. Again, something that may have been avoidable with better planning. Now, let's talk about his income tax rate. With his standard deduction of just $13,850, he's darn close to that 24% tax bracket. Either way, he's got a lot of income that was taxed at 22%. And, oh yeah, he's from New York. Well, in New York, most folks over 59 and a half get a state tax exemption on the first $20,000 of IRA withdrawals each year. But his required withdrawal has ballooned to almost $70,000. So now he'll have almost $50,000 of that required withdrawal that he'll have to consider as New York State income. So what are some things that Ron could have done to keep himself from falling so far off this financial tax cliff? First, Social Security claiming age. Might it have made sense in Ron's case to claim Social Security earlier while his income was lower and receive more of his benefits tax-free? Remember, Social Security benefits are taxed based on a calculation of something called provisional income. It is entirely possible to receive benefits tax-free if your other income is low enough. It may also have helped keep his taxes lower after he reached age 70 and a half. Second, using zero or near zero tax rates. If you have the ability to take IRA withdrawals or make Roth IRA conversions and pay little or no income taxes, it's almost always worth considering. Take Ron, for example. During his low income years, he drew solely on cash from his bank accounts. after his standard deduction, he had negative income. He could have drawn a bunch of IRA money or converted IRA money to a Roth IRA and paid no taxes on it. What a missed opportunity. 3. Being aware of tax bracket thresholds. There is a huge difference when you take IRA withdrawals at the 12% tax bracket versus the 22% tax bracket. Simple math would tell you withdrawals at 22% are almost double the tax of those at 12. Might it have made sense for Ron to take large enough withdrawals or make large enough conversions each year to stay just under that 22% rate? Remember, those withdrawals ultimately reduce what he's forced to take out at 70.5, so it's possible that those lowered required withdrawals, he may not have had higher Medicare premiums. It's also likely he would have had less of that required withdrawal taxed at that higher 22% rate, and less of those withdrawals would have been subject to New York State tax as well. So, do you have questions for me? Let me know. Give me a call at 518-612-1060 or just visit me at www.retirementtheory.com. Do you follow me on Facebook? I think that you should. You'll see videos like these and get blog and article shares on everything retirement planning. Once again, thank you for joining me. See you next time.